Welcome back, class. We're going to ease into this third segment where we've been talking about financial markets. We're going to talk about the money market, more of a generalization of the money market. We're going to talk about gets into stabilization policy and probably going to ease a little into the monetary policy too when we're talking about stabilization policy. And we're going to talk about how the government and the central bank, and we've talked about the central bank as the Federal Reserve, guide the economy toward full employment of scarce resources. And they do that with monetary policy. The relationship between price of money and what is the price of money? Price of money is just nothing more than interest rates. Depending on the interest rate, that drives the price of money and quantity of money demanded. The supply and demand model drives, and you can actually determine the equilibrium interest rate using the supply and demand model. The demand for money, and it's defined by our authors, it is the relationship between the quantity of money people want to hold and the factors that determine the quantity. And just think about individuals that hold money. Think about yourself. With me, it's, what money I have, it's in a majority of it's in a, checkable deposit. Got some 401k, got some savings accounts, may have a CD. But a lot of money, however much, and I've got very little cash on hand because of the inflation rate and so forth. It's the rationale for actually holding, paper money and metallic coins. There's not a lot of rationale at this point in time for holding it like that. And you think about you've got a checking account or a checkable deposit, and there's, I don't want to say no interest, but the interest rate is so low on most checking accounts, there might as well be no interest, but it's highly liquid. And so you've also got things like bond funds. And you get some interest from a bond fund, so you're going to be generating a little interest payments from the bond fund, but it's got limited liquidity. So you're kind of caught between a rock and a hard place, especially depending on the outflow of funds that you have to have on a monthly basis to pay living expenses, rent, mortgage payment, gasoline, car repair, food. Depending on what those expenses are, you're kind of torn as a consumer between, do you hold your funds in checkable deposits, or do you actually hold them in some type of an interest-bearing account like a bond fund? And you can actually draw it out, using the supply and demand model. You can plot the checking, the checkable deposits on the vertical, and you can, plot the bond fund on the horizontal, and you can play around with the supply and demand, and you can determine how you're going to be able to equate between those two goods and services. And the text talks about there are a few motives for actually holding money. So holding paper currency, holding metallic coins, it's a need for medium of exchange because you've got to have some type of medium of exchange to purchase goods and services. So you've actually got a choice of credit card, writing personal checks, debit cards, or you can pay for things with cash. There's also probably a fifth option out there that a lot of your, I'll call them reoccurring bills. And I pay a lot of my, car insurance, homeowners insurance, can't pay my property taxes because they charge me such a premium for using a credit card or a debit card on there. But I can pay my utilities. I can pay, internet. I can pay gas. I can pay electricity and pay my water bill. So a lot of those recurring expenses, I can do, automatic transfers from my bank account by getting on the internet and setting it up. So you have a lot of options as a consumer as to how to pay for your daily weekly, monthly, goods and services. And it just depends on how you want to go about doing it. Do you want to hold cash in the form of paper currency or metallic coins, or do you want to take one of the other options? Also, motives for holding money, it's transactions demand for money. Money people hold to pay for goods and services they anticipate buying. And most people, at least, I guess it depends on the age group you're in, but most people, if there's an increase in income, there seems to be a corresponding increase in transactions and demand for money. Individuals that as their income increases, they seem to just make more transactions. They seem to buy more goods and services because they have more income, especially more disposable income. So you've got kind of three categories that the book points out. You've got transactions demand for money, and that's where you're holding money to pay for goods and services, especially recurring goods and services. You've got precautionary demand for money, and that's the money you hold for contingencies, car repair, repair with electronics, or if you own a home, you're worried about having to replace a roof, having to replace an air conditioning heating unit, having to replace small appliances, or appliances within let's say the kitchen. Let's say you have a rainstorm and you have water damage to your home. So those kind of, I don't want to, I guess to some extent they're considered an emergency fund, but you kind of set aside a percentage, and I tend to set aside about 20% of my income to kind of fall into this, precautionary demand for money, because you never know when something's going to happen. So transactions demand for money, we're talking about ordinary purchases, reoccurring transactions. Precautionary, it's more like an emergency fund. And then you've got the speculative demand for money. And it's, speculation, gambling. We talked about hunches when we were discussing the financial markets, and that kind of falls into that. In the definition they give you in the text, it says that the money held in response to concern that bond prices and the prices of financial assets might change. And so you're holding this speculative money in hopes of identifying a potential opportunity to take on some risk in the financial markets in return for a significant return on that investment. So that's where it kind of falls in the speculative, venue, or the speculative environment when you're talking about the demand for money. Now, some people that go to the casino, that have a bookie where they're placing sports bets, that would fall in the speculative demand for money. But I personally, I don't have money to speculate in those instances with. Now, matter of fact, I don't really have enough money at this point in time. I'm more concerned with future expectations and how I'm going to allocate my money over time than I am trying to speculate. But a lot of younger individuals or younger investors are out there speculating on a daily basis. So they need to set aside some of their income for that speculative demand for money. Investors sit on cash waiting for a good investment opportunity. And a lot of investors do. They sit on cash. They don't tie up their money in CDs or IRAs or 401ks. They're sitting on their money hoping for a bigger return on investment than they might get with some of these steadier, lower risk investments. Always remember, it goes back to the three pillars of economic thought. You've got opportunity cost, and opportunity cost is going to play into this, the three types of money demand, definitely going to play into that. You've got self-interest and optimization that plays into it. and you've got decisions at the margin or the marginal decision room, which we've talked about. And that's all going to play into those, is it transaction, is it precautionary, or is it speculative demand for money? And those three pillars of economic thought are going to drive how you allocate your disposable income among those three demands for money. And then the authors talk for a few minutes about the interest rates and the demand for money. The quantity of money held is dependent on the price of the money. And when we say the price of money is driven by interest rates determine the price of money. If there's an increase in interest rates, there's typically a decrease in the quantity of money held, because if there's an increase in interest rates, whether you're a speculative investor or not, you're going to take some of that money that you might have been holding for transactions cost or maybe precautionary, and you're going to invest it in some type of financial instrument that's going to generate a return because you've got higher interest rates. Low interest rates drive the opportunity cost of holding money low. If interest rates are low, what's your opportunity cost of holding money? Interest rates are high, it's a high opportunity cost of holding money. And then when we talk about transaction and precautionary demand, transaction demand for money, the amount depends on the income and the outlays. And that makes sense. What's your income and what are your recurring outlays? Amount can depend on interest rates, significantly depend on interest rates. The demand for money, inventory is related to the level of interest rates. So demand for money, or the inventory of money that you keep, is going to be inversely related to the level of interest rates. What did we say earlier? Interest rates up, demand or the quantity of money that you're going to hold as a consumer is going to go down. That's an inverse relationship. And why is it an inverse relationship? That inverse relationship is driven by the first pillar of economic thought. That first pillar of economic thought is opportunity cost. The cash approach earns no interest. You can deposit check and use it as needed. So that's your cash approach. You go to work, you get a check, and you cash it. The majority of people cash it. Especially now with inflation the way it is, you have a lot of people that are living paycheck to paycheck. So they're depositing in that paycheck and they're using it. Now, you can compare that to the bond approach. And remember, cash and checkable deposits have a high liquidity ratio, or the liquidity rate is extremely high because you have, on a checkable deposit, you have immediate access to it. If you were to go to the bond approach, the bond, B-O-N-D, fund approach, you have lower liquidity, but you have the opportunity to earn some interest on that money. So you may have individuals that, depending on what the interest rates are, they may put half of their check in a checkable deposit and the other half in a bond fund. And the only downside, or kind of the opportunity cost on that, is it takes 2 additional transactions in and out of the bond fund, and there is a transactions cost associated with it. Transactions cost over time has decreased as technology has improved. So if you were talking about 15, 20 years ago, there was probably a significant transaction cost with that bond fund because you were having to put money in and take money out, and you might have to go to a physical location to do that. Now with technology, it's just a matter of a few clicks on your computer, and you can transfer money in and out of a bond fund. You can transfer it in and out of a savings account. You can't do it on a CD, but the transactions costs have decreased significantly over time due to technology. And savings and checkable deposits facilitate this strategy. So if you have a savings account that earns some interest, if you're really lucky, earns some interest, and you have it tied to a checking account, you can switch funds back and forth. It's, a phone call, a couple of clicks on your computer, and you've got the money flowing back and forth between that. So it facilitates kind of this bond fund approach. And individuals are going to use the bond fund approach and the cash approach. They're going to use those and come to a determination of what proportion to put in each of those approaches, and they'll keep playing with that proportionate allocation of funds until marginal benefits equals the marginal cost. Again, goes back to consumers. What is it? Self-interest, second pillar of economic thought, and it's the self-interest, the optimization. They're trying to maximize that position or that point at which marginal benefits equals the marginal cost. And then if you think about the speculative demand, you're more likely to be in interest generating accounts. If interest believes that the bond prices are going to decrease and thus interest is going to increase, you're going to increase the speculative demand. And so, bond prices, the rise and fall of bond prices, the rise and fall of interest rates associated with the rise and fall of those bond prices drives speculative demand for money. Demand for money is inversely related to the level of interest rates. And then the author spent just a few minutes talking about the demand curve for money. And the demand curve for money, as they define it in the text, is a curve that shows the quantity of money demanded at each interest rate, ceteris paribus. All other things equal, all other things unchanged. And the demand for money, and when we talk about the demand for money, again, we've got the three types of demand for money: transactions, precautionary, speculative, is negatively related to the interest rates. If you were to plot the interest rates on the vertical, the quantity of money on the horizontal, the demand for money is downward sloping. At higher interest rates, the demand for money is going to be lower. At lower interest rates, the demand for money might be higher. And again, it's all driven by the pillars of economic thought. And the majority of it's driven by the opportunity cost of that money. If you increase the interest rates, you decrease the quantity of money demanded, which makes sense. Movements along the money demanded curve. So we're not, as interest rates move up and down, we're not shifting that money demand curve in and out. We're just moving along that money demand curve. So you go back to, it's not a shift in the demand for money curve. You're talking about movements along that demand for money curve. And at that point, you're talking about the quantities demanded. Price of holding money is foregone interest, a price that grows with the interest rate. And again, it makes simple. Some of these definitions they provide you in the text are really simplistic definitions, and they are the definitions that it makes sense, especially if you draw it out and just start looking at supply and demand. The money demand shifters, it will shift the money demand curve left or right. Now we're talking about not movements along the money demand curve, we're talking about shifting the money demand curve left or right. Real GDP, and especially we're talking about households and incomes, if there's an increase in income, there is an increase in money demanded. So it's going to be shifting it in and out. And they provide you a formula in the text that says money demanded equals K times capital P times capital Y. And they define it as, capital P, capital Y is nominal GDP. That's in their formula. Real GDP is the capital Y. Price level is capital P. And K is the proportions of the consumers hold, proportions of money that they hold. So as the money demanded increases, it's going to increase, the money demanded, again, is going to increase as Y, the real GDP increases, and it shifts the curve to the right as Y increases. It shifts the curve to the left as Y decreases. So as real GDP increases, the demand for money tends to shift the demand curve to the right, and it increases it, shifts the demand to the left as it decreases. And when we talk about the price level, again, talking about the demand for money equals K times PY. As the price level increases, the demand for money increases. Price level increases, demand for money increases, because you've got to have more money to pay for those transactions and to purchase those goods and services. And then one of the other demand shifters is expectations. There we're starting now to get into speculated demand for money is based on expectations about bond prices. As bond prices, if you're a speculator, and if you expect bond prices to increase, then the demand for money is going to decrease, right? Make sense? If you expect the increase in expected future price levels, if you expect an increase in future price levels, you're going to reduce your demand for money. And inflation is one of the worst devaluers of money because it just erodes the value of money as inflation increases. So as price levels go up, who wants to be holding money? You want that money in some kind of an asset that is not, I don't want to say inflation proof because some assets tend to be more inflation proof than others, but you'd like to be holding that money in an asset that does provide some offset to inflation. And then you've got transfer cost. And, cash approach versus the bond fund approach. And, while banks facilitate transactions, as the increase in the cost of the bond fund approach increases the demand for money. If you've got a lot of transactions cost and turning that bond fund into cash for a medium of exchange, you're going to want to hold more cash. You're going to lean more toward the cash approach than you are toward the bond fund approach. And then lastly, we're talking about preferences. Consumer preferences toward cash on hand, household appetite for accepting risk. You have a lot of individuals and households that are so concerned about accepting risk, especially in the economy that we're facing today with inflation and the uncertainty of the economy. They are really concerned about accepting risk, and they may hold more cash on hand. Attitudes toward risk and yields are going to drive, and that's when you're talking about preferences, because bonds are risky, savings accounts are not so much. Bonds are risky, but they offer potentially higher returns and higher interest rates. Savings accounts are less risky, but the interest rate level is not comparable to the bond funds. And the authors at this point, now they start switching to the supply of money. And when they're looking at the supply curve of money, it's the curve that shows a relationship between the quantity of money supplied and the market interest rate. All other determinants of supply unchanged. So again, they're talking about ceteris paribus, all other things equal, all other things unchanged. And if you plot the interest rate on the vertical and you plot the quantity of money on the horizontal, the supply of money is a vertical curve. The equilibrium in the money market, and when they talk about the money market, it's the institutions through which money is supplied to individuals, firms, and other institutions that demand money. The money market equilibrium itself is the interest rate at which the quantity of money demanded is equal to the quantity of money supplied. So again, plot interest rate on the vertical, quantity of money on supplied quantity of money supplied on the horizontal, and it's where that downward sloping demand curve intersects the vertical supply curve, and at that interest rate, that is what drives the equilibrium. That's what drives the money market equilibrium, and it's what's going to drive the equilibrium between interest rates and the quantity of money demanded. Changes in money demand, the money demand curve shifts in and out to drive interest rates. So money demand curve shifting, I'll say up and to the right or down and to the left. And because you've got that vertical supply curve, right, it's going to drive interest rates up and down. And, you know, when we talk about changes driving the demand for money, we've talked about them before. We've got, you know, transactions cost, we've got expectations, we've got preferences, we've got the shift from the cash approach to the bond approach. You've got macroeconomic effects, you've got interest rates, you've got the price of bonds, which those two drive each other. You've got the price level, you've got the real GDP. So you've got a lot of interactive factors driving this demand for money. And it's going to drive changes in the money supply. The Fed increases the money supply when the market is equilibrium through open market purchases of bonds. Some impacts of changes in the money demand, but in different directions, but the same impact. So you've got the Fed playing around with open market purchases, and we talked about that, I guess, last time in the chapter. And so the Fed actually, at the end of the day, through their open market purchases and their management of the money supply, they can actually control interest rates, price of bonds, price level, and the real GDP. A lot of power in the Federal Reserve. A lot of power in which they can manipulate interest rates, price of bonds, price level, real GDP by impacting and with their monetary policy. And with that, it's going to wrap us up. And I think in chapter 12, I think that's where we get into monetary policy, and we'll dig a little deeper into the impact of the Fed and their monetary policy. But you've got the Fed is it's a powerful organization, and depends on how you look at the Fed. Some people, some individuals, especially some economists and talking heads on TV, complain that the Fed oversteps bounds and, you know, may not have their act together. But at the end of the day, the Fed is an extremely powerful institution, and they are going to significantly impact with their control of their management of the money supply and monetary policy. They're going to have a significant impact on not only financial markets, but on aggregate demand and aggregate supply. And we'll talk a little bit about that when we get into chapter 12. Until then, I'll see everybody back when we jump into chapter 12. Thank you.